And yeah, I'll run through this, but if things do pop up, by all means, go ahead.
Let me introduce you.
Yep.
So, welcome everybody to another exciting edition of the Startup BootCamp. This is week 4, and we have a very special guest today, Gadiel Morantes, the CEO of Early Growth Financial Services. And as we mentioned, this is the 4th out of 5. We have already talked about customer discovery and your go-to-market plan and intellectual property. And this time we're talking about financials. And there's many different things that Gadiel is going to cover with us. So get your notepads handy because he's going to be talking about some of the most essential things about staying in business, which is to have money. And this is something that you're going to start with, something you're going to need to be managing and accounting for and tracking. And you're also going to be, in many cases, raising funding. And Early Growth Financial Services is there to help young companies at the earliest stages of their life cycle. So they have a certain place in the startup ecosystem, and he'll be telling you what that role is. And he's really extremely knowledgeable. His company has a lot of really qualified CPAs, CMAs, and other financial experts who have a nice Rolodex as well. And so we're really honored that he's taken the time to be here today. So, Gadiel, I'd like you to take over and lead us through the financial jungle, if you will.
Such the riveting topic that it is, right, Jay? But thank you for that very kind introduction. I like to tell organizations like this is really where a lot of the fun happens for me, talking to really interesting new companies that are doing some super innovative stuff. And we work with a lot of these types of companies through their life cycle. So it's always fun for me to kind of give back to the super early stage community, and hopefully these companies grow and scale to a point where we can truly help them out and help them take them to that next stage, whether it's next stage in funding or growth or just navigating the financial landscape for them. Yes, I'm with Early Growth, and we are an outsourced accounting and finance firm. Work with a lot of early stage businesses through growth stage, and supporting them in a couple of different areas. The first one is just the basic outsourced accounting. As companies raise money, they need that support that will help them really scale the business, help them manage their money, budgeting, forecasting, things of that nature. And when they go from that, they'll need tax services, valuation services, and we can help assist in all those areas. And just as a check, I'm sorry, I'm actually sitting outside, but do you hear any background noise, or are we okay with this? Okay, perfect, awesome. Sorry. Sometimes when the leaf blower starts going off, it's one of those things. The pleasures of work from home these days, right? But as we kind of navigate through these companies, there's, with startups, being founders, it's really important to focus on your business and the growth itself, right? There's enough for you to worry about in those areas. And so that's why organizations like ours really helps support you on the financial side of the house, so that you don't need to become an expert in that world. You leave that expertise to us and our team, while you really handle building your business and going down that road. So we are the largest firm in the venture capital space that does this work. As I mentioned earlier, outsourced finance and accounting. We've got a team of senior accountants that do the basic blocking and tackling, the day-to-day transactional accounting, financial reporting, things like that. We have a team of CFOs throughout the U.S. that really help with more of the strategic work and strategic consulting. These CFOs come in and, they're working for you on an hourly basis, so you're not having to hire somebody full time. And they can help you with budgeting, forecasting, financial modeling. The background and experience of these CFOs is key because they can tie in directly to your business. And we really try to, match up folks that have some type of background in the space that you're at. We also help with taxes, tax return preparation, filing, consulting. And with the technology companies these days, there's a lot that can be realized around R&D tax credits, and navigating that as you hire employees and folks doing the tech part of the company. Depending on the type of business you are, you can offset some of the payroll taxes with the R&D tax credit studies. We help with 409A valuations, cap table management, and then fund accounting. Did you hear that now? This is the background noise?
Yeah. I
So
was about to say, if you could please speak a little louder, because the lawnmower,
let me
I think,
transfer.
drowned you
Yeah,
out.
let me actually just pause this. I'm going to migrate inside. I apologize, you guys. All right, and I'm back. Sorry about that, folks.
Not a problem.
Much better, even for me. Couldn't hear myself think. So just to round it out, you know, I was mentioning the 409A valuations, which we'll cover in a little bit more detail in a little bit, and then cap table management. And we also support a number of early stage venture funds on the fund accounting side of the house as well. So that's a little bit about early growth. And I'm actually based in San Francisco Bay Area. Worked with a lot of large public companies early in my career, helping them as they were going through their IPO process and supporting them once they were public companies. But really realized after that company got acquired that I wanted to help earlier stage businesses. I just felt like, you know, we're much more of a partner, helping them grow, helping them scale. And that's why, you know, doing conversations like this for me are really fun, and I feel like I'm much more impactful than helping a large public company kind of navigating those types of waters. So what are the considerations as early stage businesses really, you know, kind of get started? You know, we kind of break this out in a couple of different groupings. And the first one is pre-funded. Majority of companies will be just bootstrapped, where the founders are coming in and putting in their own money, their own sweat equity on trying to build those businesses. And so what does that mean, you know, earlier on when it comes to the accounting and finance side? The important thing here, it really starts with kind of, you know, the legal setup of the business is kind of the first point. And you know, you may have covered this earlier, but if the company does expect to grow and scale and raise money down the road, then from a legal perspective, the majority of those businesses are Delaware C Corps. And that's really important because as you're kind of building and creating, many companies will start out as a LLC or an S Corp, and these are more pass-through entities for the founders to whatever money that they've put in, they can kind of realize on their personal returns and take credit that way. However, investors are not going to want to invest in companies that are LLCs. They're really going to want to invest in C Corps. And as the company grows and scales, it's really important to have that legal entity set up. And we'll talk about kind of the tax ramifications of that in a little bit. But first, what happens, you know, hiring a good attorney to help you with that setup, it's pretty simple to do very early on. However, I always recommend, you know, bringing in somebody who understands the early stage world to help with that setup. The next thing that you'll want to do as founders is really set up a bank account, a corporate bank account for that business. And we've just seen over the course of the years doing this, where founders really start kind of tripping over themselves on separation of the corporate and personal expenses and not having kind of that clear separation between them both. And so that becomes really, really important. Looking for a bank that can support early stage businesses. There's many of banks out there that really focus on the early stage. Silicon Valley Bank, First Republic Bank, you know, PacWest Bank. They've all got kind of early stage programs for banking these businesses earlier on. And what's nice is you open up the business account, and it's really important to just track whatever expenses you have coming in and coming out, and being able to do that through one bank account is a lot easier, especially from, you know, the accounting side at the end of the year, trying to unravel what are personal expenses, what are business expenses if you're operating through a personal bank account. the other nice thing is applying for a business credit card and being able to, maybe you can realize some points and things like that you've got coming through that corporate card. There's a lot of really good corporate cards these days, not only from the banks, but also startup focused cards like Brex and some of these other ones that will help not only manage those expenses for you and give you really solid reporting at the end of the year, but then the benefits of some of those cards can be really, really nice too from a corporate standpoint. And ultimately, the reason we're saying this is because as tax preparers at Early Growth, there are those situations where we're working with early stage businesses, and at the end of the year, we're ready to get their tax paperwork done. And I use the example of it's kind of the old school shoebox of receipts that's going to create a lot of time for us to unwind what's a personal expense, what's a business expense, do they qualify, do they not qualify, versus just having a download of the bank statements over the course of a year can be a lot easier to unwind than the old shoebox example there. Many companies at this early stage don't necessarily have the need for, when we think about employee base, because a lot of times they're not necessarily that well funded quite yet. And so you're working with contractors, you're working with outside folks that are kind of helping you through this process. And so really, if you have any revenue and you have any paying clients, it is really important to start setting up terms and collecting those payments, right? It can be really easy to forget what invoices need to get paid, what invoices are being received, and what's going out. And so managing and putting a process in place for that can be really important early on. And this is just all comes down to kind of the general record keeping for a business. If you have employees and you are going to pay somebody a salary, it is really important to select an appropriate payroll provider and an HR provider, and also go work through the considerations of whether you're offering your employees benefits or if you're not, or if you're providing them a stipend, things like that. And so all of this at the end of the day are just systems that you want to put in place early and make sure you're tracking them accordingly. And then also when we talk about kind of the stock records, as co-founders, you're each owners of this business. And then you're thinking about if you're going to grant options or stock to any new employees, because maybe you're trying to keep their salary down, or you're just incentivizing them for the potential growth of the business. And so keeping track of all this information is really important, not only for tax purposes, but also just for the business purposes. And investors down the road are really going to want to see all of this record keeping. One of the things that I don't have on the slide, but it was advice I was given a long time ago, which was, it's really simple and easy to start setting up a Dropbox account or a Box account, just something corporate where you can just create a couple of folders and manage that paperwork within one shared area, and it can be nice and secure. You can create it paperlessly. It's really nice. And the way I kind of have advised founders to do it is, set up a Dropbox account, separate a folder by year. In that folder, you can have expenses. In that folder, you can have income. In that folder, you have legal documentation, paperwork for taxes and things like that. So then at the end of the year, if, I'm coming to you and saying, hey, share all your bank statements with me, instead of having to go download them all over at the end of the year, you can just have them in one repository, and it's easy to pull them that way. Or if investors down the road, as you're fundraising, are going to ask for the incorporation documents, your stock paperwork, your cap table paperwork, all that stuff, you'll already have that paperwork all in one location for you, which will be really helpful and a time-saving exercise versus trying to dig it out. Mentioned a little bit of this regarding expenses, but it is really important that you're keeping track of all of your receipts and the invoices and the expenses that you have, in order to be able to, write this off during tax period and realize what has been invested in the business from your own pockets. Anything that's over $75 will require a receipt. And so that becomes really important when you're working with your tax provider on providing them all the information they need. And that's why, again, kind of referencing the data repository piece, it's really easy to just take a picture of your receipts on your phone, or download Evernote has a scanning app where you can just scan your receipts and go ahead and upload them directly into your shared file there. And now you've got it all there, and even managing it on a spreadsheet. Not at the early stages, it's not always necessary to use an expense reporting platform like Expensify or Abacus. Those are really helpful and can be really solid data repository sites. But a lot of very early stage businesses, a simple spreadsheet, a Google spreadsheet with your expenses, along with capturing receipts by taking a picture and uploading them to a shared file. A lot of times that's enough, especially as the company's really early and growing and scaling, and you can track kind of your expenses that way. And the other thing is, if you're paying out of pocket for certain things, inevitably it will happen. Maybe the corporate bank account doesn't have enough money in it, or maybe you have to manage a transfer and you just got to get a payment out and it's coming out of your personal account. Just make sure that that's all recorded in that spreadsheet as a personal expense that you're going to get reimbursed for from the corporation. So that's really important to just keep a track of at the end of the day. And I know we do have a couple of folks here, so if you've got any questions, by all means, chime in, let me know. I do get tired of talking myself the whole time, but I can do it. And then we've got, moving on to kind of the pre-funding the cap table, which is really the capitalization table of the business, and really showing who owns what part of the business, right? And so this is always going to be tracked at the very early stages. A lot of times it's a single founder or a co-founder, but you're managing what is our equity split in the business, who has equity, have we granted any stock options to any employees, or are we looking at potentially carving out 20% of the business that we will be offering up to employees down the road. So just having a simple cap table and understanding this from early on is super important, because the cap table will get more complicated as you bring in outside investors, and let's say you take on an investment for $100,000 for 5% of the business. Now you have to track that 5% separately from the ownership stake of the founding team and whatever employee stock options and things like that. This does start getting complicated as you raise more and more money. And we've seen that a lot of times founders, during that first round can really manage this piece of it themselves. But as they bring in outside investment at different valuations for the business, the cap table can get more and more complicated down the road. And that's when they start leveraging an actual cap table management platform like a Carta or CapShares or folks like that. But I typically tell clients and companies that you can wait until after you've got that kind of first equity round of funding, or depending on how many investors are coming in on your first your safe note or things like that, that you'll start managing this piece of it. So in terms of compliance obligations for early stage companies, I say it's simple, but it can be complicated, but there's not a lot. This is something that, working with so many international businesses expanding into the US, this is one of the big pieces that they reach out to a firm like ours to take care of, just because the state and federal taxes can become really, really complex. Each state, each city may have different business licenses that you have to go through, and the different filings that you have to do. So at its core, as I mentioned earlier, kind of starting with the C Corp filings, if you're creating, majority of companies that we work with and the majority of venture-backed businesses are Delaware C Corps. And so what that means is that they're incorporated in the state of Delaware, which now requires them to file a Delaware franchise tax. that franchise tax is due by March 1st of every year. It does carry a pretty stiff penalty if you're delinquent on that filing. And so I always advise founders, just set yourself a reminder to pay that franchise fee every single year so that you don't have to worry about it. It's pretty easy to pay that online and take care of it through the Delaware franchise tax website. Early stage company with zero revenue and they're just building a business, that filing fee is going to be between $400 to $450. So, sometimes companies will enter in how much stock is outstanding, and they'll tie in evaluation, even though they're pre-revenue companies, and they'll come out with a filing fee of like $17,000, $20,000. I always have to kind of walk them off the ledge a little bit and back up in terms of the calculation. So sometimes it does get tricky. I always advise just reach out. It's a super easy fix from that standpoint. But beyond that, looking into the state and federal taxes do need to be filed even if you're pre-revenue. And so depending on what state you're in, I'm in California, so I'm going to have a flat California tax, even as a pre-revenue business, which is an $800 tax currently. And then I'll have to file federal taxes on the business, but pre-revenue, things like that, you're not paying anything in federal taxes until you're actually generating revenue and becoming profitable. But it is important to stay on top of those tax filings. One of the reasons I say that too is because not only with Delaware, but your state and federal returns, is that as you go out to raise money, investors are going to want to make sure that you're compliant along all of those areas. And that's something that we've had a couple of founders come to us with emergency situations where it's like, hey, I've got an investor ready to write me a $2 million check, but I haven't filed 3 years worth of taxes. And now you got to wait for all that work to get done and before you get that check. And then as a side note on that, investors want to see that you're responsible and understanding like what your obligations are from a corporate level. And so that's something that it's just kind of a bad look if you're not complying on things like your taxes or, certain business licenses or things like that. The other thing to consider, when you think about business licenses, when you incorporate and also different cities will have city taxes that you may have to pay. And so it's always important to just double check. San Francisco has a city tax, New York has a city tax, different cities have that. And so it's just important to check that up front and make sure that you are aware of those as the company continues to grow and scale. The other consideration there is if you do hire employees in other states, now you may have obligations to file returns in each of those states. And so, sometimes it's nice, and especially in a more virtual world, to have employees in different locations and things like that. However, the obligation may actually start getting cost prohibitive if you have 3 employees in 3 different states and you're based in California, and now you have to file a tax return in each of those states. So just something to consider in the back of your mind as you're building your business. Inevitably, as companies grow and scale, the hope is that the founding team can bootstrap this all the way from bootstrap to IPO and never raise a single dollar and make out with millions and millions, if not billions of dollars. But often in this startup world, fundraising is something that is going to have to get tackled. And part of the reason for fundraising, and this is something that we work with clients a lot on, is what are the reasons for fundraising? Is it to go out there and be able to really accelerate growth by hiring folks, expand on marketing, expand on sales? If it's a life science, biotech, med device company, a lot of the fundraising comes down to, I just need to build what it is that I have, right? So a lot of that money earlier on is really spent on research and development to get to that stage. If you're a biotech business going through different trials and things like that, I mean, obviously that can be really, really cost intensive. And so having that capital, outside capital, becomes really important. However, with fundraising, now you have another set of obligations that are really important, and you have outside investors. And so that's something from a finance and accounting side that becomes really important for companies to navigate. So as we think about, and in my role, I work with a lot of our clients that go through the fundraising exercise. And so part of it is not only preparing for the conversation with investors, but also understanding what do investors want to see, how's that conversation going to go, and how do I best position my company to generate and be able to get that capital. And so some of the key pieces of that is creating an executive summary of the business. And this is something, and Jay, I don't know if I've done this in the past, but with this deck, I'm also happy to share with you kind of our template executive summary. And, we've got a template for kind of the pitch deck. And I'm sure, the program's gone through a lot of that, but just throwing that out there, if you'd like any of that, I'm happy to share.
Yes, for sure. We can talk about that and maybe add that to our list of items that we can offer.
Oh, of course. And so executive summary is really a one-page summary of kind of what the company's planning on doing. And so typically it's a paragraph or two describing who the business is, what it's doing. It talks a little bit about the leadership team in terms of who the founders are and the key people in that leadership team. Also indicates what the fundraise goal is and what percentage of the business is going to be part of that exercise on raising that outside capital, and then where that money is going to be spent. So this is typically a one-page brief summary of here's who we are, here's what we're raising, here's who the team is, and here's the ask, right? And what we expect to do with that ask. Then you have a pitch deck, which tends to be closer to anywhere from a 12 to 17 slide deck that really walks through the business in more detail in presentation style. And I've got an example of kind of what those slides will look like in a later slide here, but I always kind of tie that into kind of the next piece, which is the elevator pitch, which is that 30-second to 1 minute. Can you articulate who you are in that 30-second to 1 minute so that somebody can understand what that company is? It really becomes important to kind of use each of these stepping stones as you're working through the fundraising process, because having this conversation, you're going to have many of these conversations, and it's really important to have each of these down. And I always say, like, practice them often, even the elevator pitch. If you're in an elevator with a stranger, practice it. It's, practice makes perfect, and you never know that situation. You'll actually be next to somebody and they'll ask you, well, what do you do? Having something really simple and easy that anybody can comprehend is going to become really important for the company. So here's kind of an example of what we, when I work with companies and advise companies, like what I need to see in their fundraising pitch deck in order to present this to potential investors. And this is taken out some, like an initial slide that can easily be the company name with kind of the tagline and like, going into why have we created this company? What are we doing here? If you have a stellar team that has done this 3 times over and knows what they're doing and is going out on the fundraising trail, maybe that team slide and that management team slide, maybe that's the first slide in the deck or the second slide in the deck because you want to highlight that piece of it. But more often than not, what I see is an investor asking, like, what's this company? What are they doing? Why are they doing it? And is the market big enough for us to write you a check to realize it on the back end? And so here you'll see in this example, having the mission vision slide is really important. What is the problem you're trying to solve? And really being able to show this off in a way that's visually compelling to the potential investor. What is the market opportunity? We want to be cognizant of not just throwing massive numbers here, but being realistic but aggressive still, because you do want to instill in the investor that the market is large enough for them to want to invest in your business. What's our go-to-market strategy? piece of where, not only where do we expect to be in terms of our market, how are we attacking our market, but where are we today too? That becomes really important in thinking through, this investment that these investors are going to write us a check for is going to help us get from A to C. And that's where, that we start tackling that market opportunity. What's the actual product and what does it do and how does it do it? And being really simple here, I've seen some slides where they've tried to link videos, they've tried to, do special flashy things. And ultimately we got to realize, especially in this on the go world, that like the simpler, the better here. It's great to have a visually compelling and beautiful deck, but also understanding that people may be viewing this on an iPad, on a computer, frankly, even on a phone, as they're looking through the 50th deck of the day, right? So you got to really be clean, simple, but nice enough that it actually moves the needle visually. Who is the competition? This is something that a lot of times I'm telling founders, where's your competitive slide? And they're like, oh, well, we're unique. We're one of nobody. It's just us. We're the only ones doing this. And then I go do a quick internet search and I find two folks that are slightly competitive. And so it's important to understand that as unique as our business is, we're always competing with something else, whether it's a direct competitor or if it's, sometimes the competition is somebody not doing anything versus choosing us, right? And so being able to navigate that and articulate that becomes really important, because the worst case, and unfortunately, I have sent decks out before to investors and said, hey, this company's raising and here's their what they're doing. And they come back and they said, well, there's a direct competitor of them in the East Coast and they've got like this much traction. Like, why would I want to invest in this business? And if I can't answer that, or if the company can answer that, that becomes a real problem there. Tying into the key financials, and we'll talk a little bit about tops down and bottoms up financial projections. But this is just at a very high level. Again, this deck, it's only a 12 to 17 slide deck, and this deck is really aimed to getting in the room with the investor so that you're walking through this deck with them and articulating in more detail where the company is, where it's planning on going, and things like that. But it's important to understand that like the financial slides and the growth milestone slides and the fundraising, like that you as founding teams have really thought through where the company is going and heading, and you understand that so that you can articulate that for the investors down the road. Management team and the milestones and the funding requirements, these are all just key pieces that also need to be included or should be included so that the investor can at a high level understand, is this the right folks? And if this founder is not a technical founder, but I see on their management team that they've got a technical co-founder, that just helps me feel more comfortable in potentially meeting with this business and understanding that they do have expertise, that they do understand what they're doing, or that vision is tied in with somebody who can actually execute on it. In terms of going into the financials and preparing this as the exercise of fundraising, it becomes really important to understand as we mentioned earlier, kind of like starting with the tops down and what's that tops down financial look like in terms of, is this market a big enough market that's going to require us going out and raising venture capital money, understanding that venture capitalists want a very high return. So they're going to write, 10 to 12 checks a year to different businesses, and they're going to want to see a return in 7 to 10 years. And that return, those big returns and those unicorns pay for the other 4 checks that don't work out, or the 5 checks that don't work out. And so really coming to this and saying, well, the market size is huge, and here's what we're tackling out of that market size, and drilling down into that specific. And so, again, doing homework and being realistic is saying, hey, this is $1 billion market and we're chasing half a billion of it, and here's why. And articulating that is really important. But if you can't kind of justify that market size or those numbers, don't just make them up. Sometimes it is hard trying to get, drill down into that, but it is important to be able to navigate that and share appropriately with investors. What segment are you trying to tackle? A lot of times with companies, it's a big pie that they're trying to tackle. But I have to, when I work with these companies, I say, okay, but what's the first slice you're going after? Because you can't tackle it all at once. Amazon started with just books, right? That's all it started with. And now it's groceries and it's, on demand. It's a bunch of different things. It's audiobooks. It's a bunch of different things, but it started with just books, right? So it's important to kind of see the forest for the trees from that standpoint and understand we're starting with point A. Eventually we'll get to point Z, but we're not distracted by Z because we need to conquer A first. And so that becomes really important. And so how can you extract that revenue at the very beginning stages? And so that's why this type of projection is really important to just understand and work through. The one that may be a little bit more useful at the end of the day, though, is the bottoms up financial and working through, okay, here we are, we're a couple of founders, we've got an idea, what's it going to take for us to get to certain revenue milestones in a couple of years? Are we in R&D phase? Is it going to take us $1 million to get through that R&D phase, to get to that revenue stage? How many employees will that take us? How much spend will that take? Will that incorporate? Can we realistically be at 5 million in revenue in 3 years, 10 million a year after that, 20 million a year after that? Like, let's really start with those pieces and break them out. What's our marketing spend? What's our headcount spend? We're backing ourselves into those numbers, understanding that we're trying to achieve certain growth milestones in the next 3 to 5 years. For early stage investors, having kind of that 3-year forecast is usually the norm, because anything past that, it's kind of shooting darts at a dartboard, because, in the past year, we've had COVID, we've had a bunch of changes. Nobody was there's just so many variables for early stage businesses that you navigate. Maybe you take a pivot and you do a pivot a year and a half in because you found another, where your business is more impactful and can generate revenue immediately. So that's why this, 3-year model, it tends to be really, really a good starting point. And again, the financial model for businesses, like, this is a living, breathing document. This isn't something that just stays static. You're iterating and building off of this on a very, very regular basis and revisiting it on a very, very regular basis. So this is where a lot of founders want to get to, is post-funding. Like, once I've raised my money, what do I do next? And with that, now we realize that we've got new bosses and we've got new obligations now that we've got outside capital and reporting to that. And so that's when, from an accounting perspective, things really start getting serious. And we're turning into more of adults when we think about, like, our businesses. So, before, maybe the company was operating, as I described earlier, as more of the cash in, cash out. We're just tracking cash expenses and doing it on a cash accounting basis. But now, as investors are coming in, this needs to be shifted to more accrual accounting, which is recognizing that revenue as it's occurring, and not necessarily if we're charging our clients for a full year in advance. We have to divide that up by 12 months. And as each month passes, we can recognize that revenue, versus cash, which is just, we received a check for the 12 months of services or whatever, and we're realizing that cash hit our bank account, and now we have the cash. So that's kind of the main differences between cash and accrual accounting. But all of it, the backbone of all of this is really having the accounting done according to GAAP, which is according to generally accepted accounting principles. And so GAAP is something that, for us at Early Growth, all of our clients are GAAP. And we just, even if they come in cash saying they don't need it yet, like, we make sure that they're, under GAAP accounting rules. because maybe they'll get audited. Maybe the investors are what the investors are going to want to see are that the true health of the business and the financials for the business are according to GAAP standards. And so that's something that becomes really, really important. And then a lot of times when companies raise money, they'll also take in outside debt as well. And so maybe there's an obligation to a bank or an external debt provider, and they're going to want to see GAAP financials as well. One of the things that we see a lot of companies when they go through fundraising is, especially at a Series A or at a Series B round, is they'll raise a Series A funding, let's say $5-6 million for that round. They also go out and get venture debt. And so they're basically getting a debt associated with that equity round based on the investors that they have. And so it's always, I always talk to founders, and founders say, well, if I just raise that money, I shouldn't take on debt. And my argument always is, well, it's better to take on money and bring on that debt when you have that fresh capital, because the debt providers aren't going to want to give it to you when you're running out of your cash, right? And so it's just kind of that balancing act of understanding that it's not truly, it is debt, but the instrument of that debt is coming based on the equity that you've just raised on that funding. So hopefully that makes sense on that side. And here are some basics, as I mentioned earlier, as part of this program, happy to share the slide deck so that it can be shared. But, just really the basics of the accounting principles, and thinking about these are things that we start doing as accounting professionals once the companies engage us, is we set up a chart of accounts, which is basically creating separate buckets where each of the expenses and the cash and accounts receivables and supplies and equipment, like all of that just starts getting separated out in these specific buckets. And those are called the chart of accounts. And so that every expense that the business has and everything that the business is receiving in terms of revenue, it's all bucketed in specific areas so that we can report them as such. And this is all called the chart of accounts. And again, when we get engaged, this is one of the first things that we'll do is we'll take that spreadsheet of expenses and cash that you've had earlier, and we'll create this chart of accounts. Otherwise, depending on your business, you can download one now and build off of that, so that at least there is that framework as early stage businesses, which can be easily done. Here's a really simple income statement, just showing and reflecting kind of what expenses and revenues and what the base net income is for a business like this, right? So it's taking all that information that we had in the chart of accounts and really distilling it down on a monthly basis. Early stage businesses, really, a lot of the income statement doesn't get done until end of year, which is absolutely fine for tax purposes. But as investments happen and companies take on outside investors, this will be reported as part of the monthly financial package on a monthly basis to investors. And as is the balance sheet, which is really laying out the assets, the liabilities, and then also the equity the stockholders have within the business and what that equity is worth, depending on the round of funding that company has. And so, the balance sheet is just part of that monthly financial package. But again, balance sheet really, for very early stage businesses, bootstrap businesses, for tax purposes, this can be done on an annual basis, not necessarily done ongoing for those companies. And then lastly, we've got the statement of cash flows, which is just continuing to break this out in a more digestible of like what cash the business has, what cash has been received, what's been paid out, what's owed, and different activities like that. So this is just a sample of that, as well as companies kind of build through their, what will eventually become a monthly financial package. It's really important as companies raise money, and frankly, it's really important to know as early stage founders, what's my burn? And obviously looking at a burn of your own cash as bootstrap founders, but then as you raise outside capital, understanding like how much is it going to cost us on a month-over-month basis, and can we hire that employee next month? Or are we trending positively that we can bring on additional equipment and salaries and things like that? But as you raise money, for a lot of, VCs and venture-backed companies, they understand that those first couple of years, it's going to be a heavy-duty investment of money to get that company to start hitting that hockey stick, and that cash will get, worked through effectively. That's why it's really important to understand the budgeting and creating a budget for the business, but then also a simple forecast as well. And that simple forecast can say, okay, if we've got $100,000 in the bank today, what's it going to look like next month? What's it going to look like in 3 months? What's it going to look like in 4 months? And so understanding what we're forecasting out and doing that exercise on a monthly basis is really important. And again, kind of touching on the budgeting and forecasting, that's where understanding what are those key variables that you have. Is your business a people intensive business, whereas staff and salary is going to be your biggest line item? Or is it more about R&D, where equipment and spending on contractors or things like that are more of the variable that you've got there? Are you generating revenue? And if you are, how solid is that revenue? And can we assume specific revenue targets and numbers for the next coming months? And how are we trending there? Do we have any history as a business? A lot of super early businesses just don't, right? So that's why it's important to understand and be able to forecast on a month-over-month basis, and looking in hindsight, months at a time, just to see, are we trending in the right direction? Are we not? What are we looking at? And reviewing this quite often, and having each of the stakeholders really review it. If you have a sales team, reviewing the forecast with the sales team. If you're R&D heavy, then reviewing all that becomes really, really important, and making sure each of the stakeholders understand, because once investors come in as well, they're going to want to see and understand what that's going to look like. Because if you've got $2 million in the bank today, and then they see you next quarter and you've only got 500,000, that means that you're spending a lot of money, and potentially fundraising is important there, right? And also, are you trending towards having used that money that you did raise, and is that lasting you that typical 18 months to 24 months that happens as companies look to fundraise? It's typically that 18 months, and then they're going to have to go raise more money, or the business will be generating much more revenue to help sustain it. So the internal controls, this is really important to start understanding that you're going to want to set up checks and balances, especially on the accounting side of the house, early or sooner rather than later. And so when I think about our clients, when they engage us, this is one of the first things we do, where we're not actually touching the money. We have to make sure the CEO or somebody in the executive team is actually pushing the button and approving payments and things like that, right? So it's not always good for the one person within the company to be able to write the checks and have access to the money, right? There's got to be some setting up of a control, and this becomes important at audit period as well with companies, and saying, hey, are we going to get audited? Do we have that that control in place, and the different approval processes? If I'm producing an expense report, can the other person approve the expense report, and then another person actually pay it out, and things like that. So as the company grows and scales, and as you have different departments, obviously this becomes even more important from that standpoint. And then as the company matures, as I mentioned earlier, starting in a shared spreadsheet and carving that out by month is a really, simple, easy place to start. But then things will get more complex, and company will have more money and have more systems they'll have to implement. So the accounts payable and the AP system, expense reporting, I mentioned, like Abacus and Expensify, accounts receivable and payable. A lot of times we leverage Bill.com for many of our clients. Outside of all these tie into QuickBooks really nicely, especially for early stage businesses. It's a really cost effective, easy way to start it off. And then having a payroll system in place that can help you with your payroll taxes and onboarding employees and making sure they're getting paid and setting up those types of things are really important. And what becomes important for businesses as they look to take outside money and build the business is really what's the value of that equity of the business. So if you're handing out stock options and employees are owning part of the company, then getting a 409A valuation is really important. And that's really to realize like the company's stock is worth very little today, but the hope is at time of exit, 5, 10, 15 years down the road, that capital gains and that stock has grown so much. And so the IRS wants to be able to tax on that. And so that's why 409A valuations are really important in getting them that they will withstand a Big Four audit and withstand the growth of the company becomes really important. We typically see this at a Series A or even a seed round of funding that companies will get a 409A valuation done and have that in place. And again, get the valuation, stick it in your shared folder and have it available, and you'll get these refreshed on a year-over-year basis. So thank you very much for listening through this presentation. Again, happy to share the slide deck, happy to share samples of the exec summary and things like that. And even I think we've got a basic accounting package that I'm happy to share, Jay. So just let me know. But thank you for the time. Again, Early Growth's here to help, and I never hesitate on having people reach out if there's any questions. Feel free to share my contact info. Happy to help where I can. But hopefully this is of value.
Okay, thank you for sharing this, and hopefully more people will be able to see it. So we are going to post it on our YouTube account. So
fantastic.
So Iris or Desiree, do you have any questions? And I've got a couple, but you get to go first.
So it was a great presentation. First, you brought a lot of good information to us. And what I'm wondering is, we're an LLC right now, and what we're hoping to do is get the grant funding. Is the best accounting for us, because we're very small? The thing that I thought got confusing is because we're in our grant, we're proposing to work with an out-of-state university lab, and that's one point. And so those are out-of-state employees. Is this going to get confusing for us when we do our accounting? And should we be hiring somebody, or do we use a QuickBooks and just keep track of everything?
So grant reporting gets really tricky. And so part of it is working with that grant and understanding what those requirements are, right? How much financial reporting are they going to be asking of you? How big a grant is it? Because we actually, with companies who are taking on outside grants, the reporting can be a little bit tricky. So a lot of times they do engage with a firm like ours earlier on, just based on, because a lot of grants will say, hey, this much needs to be spent on R&D, this much needs to be spent on salaries, this much is going to be spent on marketing. And so having all that very well carved out becomes super important. And so that's why the chart of accounts becomes important for grant reporting and things like that. So I would actually look through that, the paperwork for the grants and understand how stringent they're going to be, because some grants are a little bit looser, saying we don't require monthly financials or quarterly financials. We'll look at it once a year, and maybe it's just a year-end cleanup type of situation. And then understanding, as an LLC, because it is a pass-through entity, how's that going to affect it by taking on that grant? Does it make sense to be a C Corp right now, or some type of S structure or something like that? So I don't know if I have all the answers for that. It may be worth a longer conversation, but hopefully that gives you a little insight there.
Yes, thank you.
thank you.
So I wanted to begin with a comment. First of all, thank you very much for the excellent presentation, Gadiel, and you hit it out of the park. I wanted to say that in the world of startups, when you're looking for outside funding, one of the key factors of any investor is going to be, are these guys serious and responsible with our money? And in many cases, small and emerging businesses don't meet that criteria at all. And that's the first turnoff. If you think that money is not being well accounted for, no money will ever be forthcoming. So it has to be not only, oh, we're going to take care of that when we get the money. It's going to be, they're going to look for a history or a trend of financial responsibility. So connecting with either earlier with financial services or in some way being able to prove that you know how to handle money and you're likely to use it as intended is essential. So all these things that we're talking about now at the high level are even more important when someone else is looking at you. So it feels good to be financially organized. And the other thing is this, what business that doesn't handle its money well is ever maximizing its success? And so accountants and finance, I think, play a critical role in a startup. And it's, maybe not the inspiration, but it is an essential portion of being a successful startup. And so I've heard many talks from finance and accounting people, and yours is one of the best. You guys really are in that sweet spot for emerging companies. So very valuable. In the same vein of talking about money for early startups, we have a lot of very early things, even too early for early growth. And so it was cool that you talked about, if you want to expand on this, just starting to establish yourself as an entity. Getting a credit card and paying the bill is one way of establishing financial responsibility. And you mentioned a name, I don't know if you want to say that again, of a credit card that's geared for startups and their needs.
Yeah, so Brex is a card, BREX, and Divvy, DIVVY, are two that are really focused towards kind of startup businesses and startup companies. Many of these startup banks also will offer some type of credit cards as well. And part of the value there is very similar to even getting an American Express card, where they've done a much better job at producing breakouts of the spending habits and being able to use that as part of the reporting as well. And so, you're exactly right. I mean, I think it doesn't have to be overly complex. It doesn't necessarily have to be a QuickBooks or anything like that. But if you can show investors that you've been managing your spend and tracking it all in spreadsheets to the stage where you get that investment, I mean, that responsibility can really keep a leg up. And that's why I tied it to like just making sure you're compliant on your taxes and other type of business filings as well, because those are really easy ways to just show that you've been responsible with the business thus far.
Thank you. And the other comment I wanted to make from what you said, I've never articulated as well as you did, but there's money from investors and there's money from banks or lenders. So there's dilutive and non-dilutive financing and for startups. And the key point that you made was after you receive your outside funding to go get additional finance, debt finance. And debt finance is almost always less expensive than equity funding. And early equity funding for a startup is some of the most expensive money on the planet. You need it, so you get it. But it's really a great idea at that point in time, especially if you've established some credit through your credit cards and a banking relationship, say, okay, now we need some debt and to pay it back, obviously, but you don't have to then use your fundraised money for things like producing product, because you could have some other debt instrument that doesn't give up any equity, and then will also allow your investors' money to last longer, or maybe as long. Rule of thumb, which Gadiel didn't say, but I know he knows, is that things end up taking longer and costing more than is anticipated. And so anything you can do to lengthen that time frame, either to closer to how long it was expected to be, or anything like that is welcome. So I wanted to thank you for bringing that up as well.
Oh, it's critical, and I always say it's easier to take on that money when you have money, and so it can be more true. that part of it. And yeah, you also hit an important point there, where when I think about fundraising for a business, incorporating kind of that 20%, 25% fudge factor is really important, and trying to just raise just a hair more, because to that point, like no matter how well you've done your math and how, you know, the world never goes perfectly, as we all know. And so it's something that you want to just be able to account for a little bit of that.
All right. Well, thank you once again, Gadiel, for a great presentation. And we are going to post this on the Technology Partnerships YouTube. And so this will be available. And here's the contact information in case you need to get a hold of Gadiel. And then, of course, I'm available as well if you need to follow up with any of the details in terms of some of the papers or slides that Gadiel might do send over our way. So thanks again, everyone, for being here. Next week, we're going to talk about social media and marketing. So slightly different change of topics, but it's going to be really, really interesting. And it's sort of a new and better way, or cheaper way, of getting the word out about your product. So hope to see you all in a week. And again, thank you so much.